Joining us right now is Kate Moore. She's Chief Investment Officer at Citi Wealth. And Kate, when we talked to you, was it 5 days ago? Was it a week ago? I remember how tired you were.
It's all a blur, Becky.
Yeah, it's hard to keep track of the movements that come. How do you take a step back and say, here's what to pay attention to? The futures, are they up this morning because they figure a deal has to be reached, that this can't continue for either one of these nations?
I would have a hard time believing the futures are up because of the trade stuff. I want to believe that they're modestly up because they think they're going to see decent numbers coming out of the banks that report today.
Yeah.
You know, this is the kickoff, of course, of earnings season. This is perhaps even more important at this point than the tariff tit for tat in terms of fundamental investors and for what we're really looking at. We want to make sure that we get solid commentary from corporate leaders and that they tell us they have contingency plans or at least have been thinking through a variety of different scenarios. And I think if they do that, we'll put some stability into sentiment, perhaps into the market. But I would suggest that this 125% retaliatory China tariff is not necessarily what's leading futures higher at the moment.
Okay, I guess the idea that we're going to hear from the banks and maybe get a sense that they have plans in place, it's hard to imagine that they're going to have a ton of clarity, though, because what do they know that the rest of us don't?
Well, look, I've been saying this for a couple weeks as we've been worried about tariffs, and now I have to say I'm going to double emphasize this. When companies start pulling guidance, it is a really negative sign. We know that the last time that this happened, of course, was during the pandemic when no one had any visibility. But we're starting to see companies outright pull guidance or pull parts of their guidance. And that's not great for the investor sentiment.
I guess, I mean, to me, it's like you're a smart company if you pull your guidance, because it's stupid to try and venture any guess into what's happening here. I think what I'm more interested in hearing from the banks is, are they continuing to lend to consumers, to businesses? What are the effects that they're seeing in their business lines, particularly internationally? Some of these big banks have a huge part of their revenue that comes from international banks. You've heard the EU start to threaten the idea that, OK, we don't import as much from you, but we're going to cut back or tariff your services, or we're going to do something like tax your big tech companies, all of our biggest, best companies. Yeah. Those are the types of things that I would like to hear more on.
Yeah, and I would say there's also, for diversified financials, what does cap markets activity look like right now? You know, we had all come into 2025 with great big hopes that there was going to be a better IPO pipeline, we'd see more deal flow. But of course, it doesn't feel like a great time for a company to be bringing their shares public at the moment. So I'd say that side. And then I also want to hear about, like, you know, who's concerned about margin calls? Like, how are they handling that? And, you know, which part of their population seems under stress right now? I want a message of calm, but even past the banks, as we go into next week, I think if we have companies talking about contingency plans, that will be somewhat helpful, although I don't think we're going to have a big rip from here.
How much do you worry about or concerned at all about private credit? You know, Becky was just talking about the banks in terms of credit, that folks are getting loans from traditional banks, but so much of the loan business has now moved effectively outside of the banks. And we talked to Mark Rowan earlier this week from Apollo. They're in that business. Does that concern you? And the connection, which is oftentimes, I think, overlooked between not Apollo, but actually a whole bunch of folks who are in the private credit business who effectively are backdoor levered by the banks.
Yeah, it's a really good question. I'd be lying if I said we're not really concerned, or at least thinking about the risks here. But the opacity, of course, as you well know, in the private credit space makes it hard for us to say we know where any stresses might be. And so this is something we're watching really closely. As a result, I'm kind of paying more attention to the liquid credit markets at this point, the public markets, and watching for stress there. If high yield can't come, if there's no issuance, if there's not a great secondary market, if it looks very thin, those are the areas I'm focused on because the private credit stuff is much more difficult to analyze at this point.